Welcome to the Hurst Trading Room. My name is David Hickson and today is the 16th of May 2016. Before we take a look at the markets and get into the main content of today's webinar, I would like to encourage you to please read and make sure that you have understood these disclaimers. In today's webinar, I'm going to move a little bit further down the path that we have been following over the past few webinars, and I'm going to be speaking about identifying trading entries, or how to enter your trades on the basis of Hurst cycles information, or your Hurst cycles analysis, and of course working with the Hurst cycles tools. So let's just perform a recap, and let's take a bit of a step back and remind ourselves about this particular sort of train of thought that we've been on. A few webinars ago, I spoke about the analysis in the S&P 500 and discussed the various possibilities in terms of what was happening in the S&P 500. And in that webinar, I identified the fact that the trough in February was a trough of at least 18-month magnitude. And you're probably used to hearing me saying that phrase, at least a particular magnitude, because as I've explained in previous webinars, when a cycle trough forms, we are often not entirely certain what the magnitude of the cycle is, but we can say with some confidence, what the minimum magnitude is. And in my opinion, the minimum magnitude of that early February trough was 18 months. In other words, the market is now bouncing out of an 18-month cycle trough, which you can see at the foot of this chart over here. So if I get this pen to work, there we go. There's the big trough that formed at the beginning of February. Now that is a trough, in my opinion, of at least 18-month magnitude, and it is also possible that it is a 54-month cycle trough. In other words, the 4.5-year cycle formed a trough at that point. It is also possible that it is an early 9-year cycle trough. And I've discussed this in previous webinars, so I won't dwell on it here. But in this analysis that we're looking at on this particular chart, it is shown as a 54-month cycle trough. And if we take a look at one of the other charts that I have here, this one here, for instance, you will see if I zoom in to the same period of time. Let me just clear the semicircles that get very messy when you zoom in. You can see that according to this analysis, it might only be a 40-week cycle trough, but can you see these big bars here? I need to zoom out a little bit to make those a little bit clearer. Those big bars are indicating that it is possible that the 9-year cycle trough should be forming round about this time. And so we need to remain aware of the possibility that the 9-year cycle trough might have formed. It is certainly a trough that is probably expected fairly soon, and by fairly soon I mean within the sort of time frame of a 9-year cycle. We're certainly approaching the point at which the 9-year cycle should be forming a trough. Okay, so in our previous webinar, I spoke about the process of moving from an analysis into making trading decisions. And of course, the important thing that you do, first of all, is you don't just jump into a trade. You don't say, here's my cycle analysis, oh, there we go, therefore I'm going to start buying, I'm going to start selling. The first thing you have to do is you have to identify trading opportunities. And that is really what we did in our previous webinar, is we identified upcoming trading opportunities. As a Hurst cycles trader, what you're doing is you're always looking ahead. You're looking forwards. It's a little bit pointless to sort of look behind you and say, oh, well, I should have entered a trade last week. What you need to be doing is looking ahead and saying, what is my next trade? What is the trade that is next going to be appropriate for me to make? And I spoke in our previous webinar about the fact that you usually choose a cycle that you're going to trade. And I discussed how I was going to speak about the 40-day cycle. Of course, these Hurst cycles principles apply to all cycles. So if you're trading a 20-month cycle and you want to get into a trade that you're going to hold for several months, then the same principles would apply, but you're just speaking about a much different time frame. The 40-day cycle is one that I used to trade very often. I trade much shorter, mostly intraday cycles nowadays, but the 40-day cycle is an old faithful cycle for me. I really enjoy the 40-day cycle, and so I've been speaking about identifying opportunities for the 40-day cycle. And having identified your cycle that you're going to be trading, the next question that you really have to do is you have to look at the analysis and ask yourself, what's happening now? What's happening in this analysis? And that is where the concept of a dominant cycle becomes really, really important. And in our previous webinar, I spoke about the fact that there are two possibilities for a dominant cycle. And just to remind you, a dominant cycle, I use Hurst's original definition of a dominant cycle, which is that it is a visually apparent cycle. In other words, when you look at the chart, you can really see it quite clearly. The two possibilities that we have at the moment for the current dominant cycle, which of course is going to impact our trading decisions today, there are two possibilities. The one is that we have a 20-week cycle which is dominant, and so if I draw here, a 20-week dominant cycle will be visually apparent 20-week cycle. So it'll move the market up as it has done, but then it must move the market down, okay, in order for it to be a visually apparent cycle. If you simply get an upwards moving line, that's not yet a visually apparent cycle. You have to have the downwards moving part of it as well to make it into a clearly visually evident or visually apparent cycle. And so if the 20-week cycle is dominant, then we have already seen the upwards movement for that 20-week cycle, and that was this move over here, which brought us to this peak which formed in late April. And now we need to see the next part of the move, which is the downwards move into the 20-week cycle trough. Here's our nest of lows for the 20-week cycle trough, and so we are expecting, generally speaking, or I should say sort of approximately speaking, we're expecting the 20-week cycle trough to form towards the end of May, perhaps early June. And if the 20-week cycle is dominant, then we would expect to see the market coming down fairly strongly into that 20-week cycle trough. And that is, of course, one of our trading opportunities that we identified in our previous webinar, but I'll come back to that in a moment. The other possibility, in terms of what is happening right now, is that we have a 40-week dominant cycle. And let me just zoom out a little bit and show you what a 40-week dominant cycle would mean. I need to go even slightly further back. 40 weeks is about 9 months, of course. And so if the 40-week cycle is currently dominant, then we would expect to see a strong move up to the 40-week cycle peak, which we don't know yet where that's going to form. And then we would expect to see a strong move down in order to create the visually evident cycle move, the move up followed by the move down. So if a 40-week cycle is dominant at the moment, then what we would really be looking at happening is a bit more of a move up, formation of a 40-week cycle peak, then a strong move down. So those are the two possibilities that we need to bear in mind. We don't know yet whether the 20-week cycle is dominant or whether the 40-week cycle is dominant. And I received many interesting emails over the course of the last 2 weeks, questions from people asking whether you can use spectral analysis tools, for instance, to determine what is the current dominant cycle. Well, yes, you can. And I'm not an expert at spectral analysis tools by any means. William, who's a member of our community and publishes often to the Hurst Cycles site, is much more of an expert in spectral analysis than I am. And he has mentioned that the spectral analysis he performs indicates that the 40-week cycle has been dominant recently, or you could say is currently dominant. However, there's a very important thing to bear in mind. That is that any mathematical analysis process that you perform tells you what has been happening up until now. It's really quite important. It tells you what's been happening up until now, and it doesn't necessarily tell you what's going to happen after this point. So a 40-week cycle has definitely been dominant over the past while. And in our previous webinar, I zoomed out and I showed you that we had two clearly visually evident 40-week cycles. But that doesn't mean that it's definitely going to keep being the dominant cycle. So we need to be careful of that, and we need to bear in mind that there might be a 40-week or a 20-week dominant cycle. Now, something very interesting happens when you have a 40-week dominant cycle, and that is something called a mid-channel pause. And I did a webinar about the mid-channel pause. It must have been late last year, I think, perhaps November last year. The mid-channel pause is a very important aspect of Hurst cycles work, and I'd like to point out what we might be currently experiencing, which might be a mid-channel pause. What is a mid-channel pause? Well, following a trough of a particular magnitude, and let's just cross out this 54-month cycle. The pen won't do that for me. I want to cross out that 54-month cycle diamond there. If we cross that out and assume that that is a trough of only 18-month magnitude, because it is of at least 18-month magnitude, then if we have a 40-week dominant cycle, as I've mentioned, we expect to see a visually apparent move up followed by a move down. However, let's get a little more detailed about this, because we know that cycles form M shapes in markets. And so what is actually going to happen is that we are going to see a move up, followed by a move down, followed by another move up, followed by a move down. So we're going to get two peaks in that sort of M shape. The first peak has probably formed. That is a peak of the 20-week cycle, and price is now probably moving down into the trough of the 20-week cycle, which will form the center of the M. But let me point out that price is breaking out of, or bouncing out of, an 18-month cycle trough. And so therefore, perhaps I should zoom out slightly more so that we can see the full shape of the 18-month cycle. Because it is bouncing out of the 18-month cycle, and let me just move that down a little bit, we expect the 18-month cycle to also form an M shape. So it's going to come up, form its first peak, come down, form the intermediate trough, come back up, form the second peak, come down and form the final trough of the 18-month cycle. Okay, there is our M shape. Now, can you see that if the M shape does look as I've drawn it now on that chart, then we would look back and we would say that's a fairly dominant 40-week cycle. Okay, there's the move up for the 40-week cycle, and this pen doesn't really want to do that, and there's the move down for the 40-week cycle. Okay, so that's a visually evident 40-week cycle. It's the first part of the M shape of the 18-month cycle. Now let's add a final subtlety to this very rough sort of diagram, and that final subtlety is the mid-channel pause. The mid-channel pause is a pause that happens halfway up, and you get a pause, and then you get a rise up to your first peak, then you get the move down to the center of the M shape, then you get the rise up to the second peak, and then you get a mid-channel pause on the way down as well. Okay, that is the full M shape that cycles form in markets. Now, a mid-channel pause occurs at the trough, which is 2 degrees shorter than the trough of the cycle that the market is bouncing out of. So, as I've mentioned, here the market is bouncing out of a trough that is of at least 18-month magnitude. So because it is of at least 18-month magnitude, that means that we could expect a mid-channel pause at around about 2 cycles shorter. 2 cycles shorter than 18 months is, of course, 40 weeks and then 20 weeks. So at the trough of the 20-week cycle, we could expect the mid-channel pause to form. Okay, very important consideration to bear in mind. Now, let's get back to trading and trading entries. In our previous webinar, I identified two possible trading opportunities. I spoke at length about this particular analysis that we're looking at, and so I won't dwell on it, but I favor the fact that the 80-day cycle trough formed in the second week of April. As you can see over here, there's the 80-day cycle trough. One of the main reasons that I favor this position for the 80-day cycle trough is that following a trough of an 18-month cycle, that trough at the beginning of February is at least 18 months, maybe even 54 months. Following a trough of a big cycle like that, you expect troughs of the shorter cycles to occur early. Okay, so as the troughs of these shorter cycles come in, you expect them to occur early because the longer cycles are all pushing upwards, which means we have a bullish underlying trend. So here, for instance, the 54-month cycle is clearly pushing upwards. If that is a trough of the 54-month cycle. The 18-month cycle is pushing upwards. The 40-week cycle is pushing upwards. And the 20-week cycle was pushing up, but at about the time of the 80-day cycle trough, the 20-week cycle would be topping, in other words, turning down. So we don't count the 20-week cycle, but you can see that I have a good 3 cycles there that are all pushing upwards, which gives us a strong underlying bullish trend, which means we expect the market to be fairly bullish, moving upwards. And in a bullish underlying trend, we expect our cycle troughs to occur early for our shorter cycles, and that's why I believe that that is probably the 80-day cycle trough that formed there in the second week of April. We'll take a look at a chart later where I haven't pinned that trough, I haven't positioned that trough, and you will see that it is possible that the 80-day trough didn't form there, but in my opinion, less likely, not very likely. In terms of the 40-day cycle, which is the cycle that, of course, I'm speaking about trading here. In our previous webinar, which took place here on the 2nd of May, I identified 2 trading opportunities. The first one was an opportunity that I suggested would present itself round about the middle of May. So that's round about here. And that would have been an opportunity to enter into a short trade, because at that time I was expecting price to have to be bouncing out of the 40-day cycle trough, and it would have been turning down and heading down into the 20-week cycle trough. Now that would have been a trading opportunity worth taking if the 20-week cycle was dominant and was showing itself to be dominant. So we have an opportunity for a short trade there. As it happens, that opportunity, I think, actually sort of manifested itself early last week. So it came in a little bit early, a little bit earlier than we expected. But there is a short trading opportunity, and that was the first opportunity that I identified in our previous webinar. The next opportunity will be when price bounces out of the 20-week cycle trough, and that is a long trading opportunity. In other words, we would buy as the market bounces out of the 20-week cycle trough. So now let's move from having identified our trading opportunities, and we have 2 of them, a short trading opportunity, which is happening about now, might have happened last week, we might have just missed it, but it's happening around about now. And that's going to be followed by a long trading opportunity as the market bounces out of a 20-week cycle trough, which is expected to form towards the end of May. So we have a week or 2 to really start thinking about this 20-week cycle trading opportunity. As a matter of interest, when should you start thinking about a trading opportunity? When should you start thinking about making your trade entries? Well, a really, really simple rule of thumb is to have a look at these circles and whiskers. Can you see the circle and whiskers for the 20-week cycle trough? That's over there. That means that we should really have started thinking about entering into this long trade sometime last week. Okay, so now is a good time for us to stand by and start discussing how we would enter into the trade. Now, the first thing I should say about finding your entry into a trade using Hurst cycles is that there are as many ways of entering into a trade on the basis of Hurst cycles as there are traders who use Hurst cycles. Okay, there isn't one way of doing it. There are a multitude of ways of entering into your trades. And what you need to do, of course, is find the way that suits you, suits your trading personality. But what I will speak about in today's webinar is the approach that Hurst himself suggested in his Hurst Cycles course, which he published in the 1970s. It's what I call the Hurst trading methodology. And the principles that underlie the Hurst trading methodology are really important and really useful. And I hope that once you fully understand them, you will be able to adapt them to inform your own trading decisions so that you can work out when you would enter a trade. I see a question or two there. First of all, Rodolfo would like to know if, for example, if you're analyzing the 80-day cycle, which FLD would you use? In the past webinar, you used a 20-day FLD. Great. Okay, so I am going to speak about exactly that, Rodolfo. And I see Sergio has suggested you have a look at our last webinar on YouTube. That's great. In fact, what we should do is get Italian subtitles on those webinars. It'll be useful for all our Italian users. And Nathan says, do you mean we are now in F category in the second 80-day cycle? Yes, okay. Wow, Nathan, yes, you're jumping ahead. Jump straight ahead, yes, to the front of the class. Yes, I'm suggesting that we are now in the F category of the second 80-day cycle, but I'm going to loop back to that, Nathan, time permitting, and come back and speak about the FLD trading strategy. The FLD trading strategy is something that I use and have used for years to trade because of the tremendous power of the FLD line. So I will be speaking about the FLD trading strategy, but that's not really the focus of today's webinar. What I want to speak about today is some of the sort of basic underlying principles for how do you find out where you should enter your trade. Now, the first thing to understand is that a long trade or entering into a long trade is not the same thing as a short trade or entering into a short trade. Hurst made a very clear point about that. Entering into a short trade is a fairly different consideration. And without going into too much detail, the reason for that is because of the fact that we have synchronized troughs and we do not necessarily have synchronized peaks. And that's called the principle of synchronicity, and I'm sure you've heard me speak about it many times before. But the result of the principle of synchronicity is that we get M-shaped cycles. Okay, and they keep repeating like that. And I can draw them backwards as well. Okay, and you will notice that the peaks are very different to the troughs. The troughs over here and over here are sharp and isolated troughs. They happen all on their own, and when you're going to enter into a long trade, you're trying to catch that sharp move out again. Peaks, however, are more complicated. They tend to be rounded and they are clustered together. You get two or more peaks closely clustered together when you are trading a stock. Now, when you're trading a forex pair or when you're trading a commodity, that is different. Let's not get complicated now. We're focusing on the S&P 500, which is a stock index, so we're going to apply stock trading principles today. If you want to get complicated, then you can consider what you would do if you were trading something that didn't have synchronized troughs. But for today, we're focusing on a stock or a stock index. And so you must understand that entering into a long trade is a different kettle of fish to entering into a short trade, because you tend to get rounded peaks and sharp pointed and sharp isolated troughs. So what I'm going to speak about first is how you would enter into a long trade, because that is a trading opportunity that is going to present itself towards the end of May. And so I hope that this is going to provide you with some useful information ahead of time so that you can start thinking about how you might enter into this trade. We do also have a short trading opportunity that is maybe presently open to us, but I'm going to come back and speak about that later because that's a bit more complicated. So when you're trading using Hurst's trading methodology, the first thing that you do is you ask yourself what's going to happen next. What am I trading? Okay, well, what we're trading here is we're expecting price to come down into a 20-week cycle trough expected by about the end of May. Then it's going to bounce out of it. And so that's what we're expecting next. We're expecting a long trading opportunity as price bounces out of the 20-week cycle trough. The next thing you would ask yourself is how will you know when the 20-week cycle trough has formed? Because according to Hurst's trading methodology, you only want to enter a trade when you are confident that the cycle picture that you are trading, in other words, the price is bouncing out of the 20-week cycle trough, you want to be absolutely confident that that event, that cycle event, has happened. So how can we be confident that that cycle event has happened? Well, that is where we use Hurst cycle tools. Now, there are two tools. There is the FLD, which of course happens to be my favorite tool, and there is also the VTL. This pen isn't letting me write very neatly. Okay, it's the FLD, future line of demarcation, and the VTL, valid trend line. Those are Hurst's two cycle tools. And you can use those tools to determine when things have happened in the market. So, how would we know when the 20-week cycle trough is formed in the market? The correct answer to that question is that there are two ways of knowing. We can use a VTL or an FLD. Now, there isn't always a VTL available, so we'll come back to the VTL in a moment. Let's speak first of all about the FLD. And which FLD will tell us that the 20-week cycle trough has formed in the market. There it is. It is, in fact, the 20-week FLD. When price crosses above the 20-week FLD, then we know that the 20-week cycle trough has formed in the market. Okay, I'm sticking strictly to the fundamental principles here. When price crosses above the 20-week cycle FLD, we know that the 20-week cycle trough is formed. So if you want to make your trade when you are confident that the 20-week cycle trough is formed, then you need to wait until price crosses up above the 20-week FLD. Okay, very important point. Now, many people, when I first mention the idea of waiting until price crosses up above the 20-week FLD in order to enter into a trade as price bounces out of the 20-week cycle trough, will say to me, you must be crazy, because by the time price crosses up above the 20-week FLD, the move is half over. And let me show you an example. As price bounced out of the early February trough, it came up here and crossed the 20-week FLD over there. It's not a very well drawn cross, but it crossed up above the 20-week FLD over here, just below the level of 2000. Then price continued to rise up towards the peak. Now, it depends whether you're an optimist or a pessimist, really, in terms of how you respond to that concept. The optimists among us would say, well, I don't mind missing the first half of the move because there's another half of the move still to come. So if we had entered into our long trade at the level of 2000, we don't look back with regret and say, how much did we leave behind us? But instead we look forward with optimism and we say, gosh, there's still a move ahead of us. In fact, there was a good 100-point move up to a level above 2100, still ahead of price crossing that 20-week cycle FLD. Of course, if you're a pessimist, then you would say, I don't want to wait until half the move is over. I want to get in a lot quicker, a lot sooner. Okay. Fortunately, there is good news if you're a glass half full kind of person and you don't want to miss the first half of the move. There is, fortunately, a very good news. The good news is that because of Hurst's cyclic principles, we know that the troughs of various cycles form simultaneously. It's the principle of synchronicity. They form synchronously. So let me ask the question in a slightly different way. We are going to be trading the market bouncing out of the 20-week cycle trough. So how will we know when that 20-week cycle trough is formed? Yes, we could wait for price to cross above the FLD, but if you don't want to wait until price crosses above the FLD, what happens if price crosses above the 80-day FLD? That means that we have confirmation that an 80-day cycle trough is formed. Now, we already have an 80-day cycle trough over here. You can see it over there nice and clearly in early April. So when price crosses up above the 80-day FLD again, that will tell us we have another 80-day cycle trough in place, and due to the principle of synchronicity, it must be the same trough that we've been waiting to trade, which is the 20-week cycle trough. I hope that makes sense. So let me plot the 80-day FLD, and here you can see it on the chart. And now you can see, that's giving me a black screen. I don't know why it does that occasionally. Now you can see, let me just clear that and freeze the screen again. Now you can see, if you had traded on the basis of price crossing the 80-day FLD back in February, over here, you would have got in much earlier in the move, much earlier. Most people would have probably sort of waited until that sort of level there before getting in. But nevertheless, the 80-day FLD gives you a much better entry level. Okay, but your confidence in the cycle move that you are trading is slightly reduced, but only slightly at this point. So let me remind you, the cycle move that we're trading is price bouncing out of the 20-week cycle trough. So the move is a bounce out of the 20-week cycle trough. If we wait until price crosses up above the 20-week cycle FLD, then potentially half the move is behind us. So we can instead use the 80-day cycle FLD and get in much sooner. But our confidence in the trough that has just formed in the market is only, in fact, a confidence of an 80-degree magnitude. And so our confidence is slightly reduced, but our entry level is slightly improved. Now, using this same principle, you can use shorter and shorter and shorter cycles. And you can go all the way down to, well, I know some people who go all the way down to intraday cycles and use the crossing of intraday FLDs as confirmation that a long cycle trough is formed. I wouldn't go that far. You could go down all the way down to 20-day or 10-day FLDs and use those shorter FLDs to give you a better entry level. Now, let's speak about entry. So far, all I'm speaking about is when do you have confirmation that a trough is formed. According to Hurst's trading methodology, yes, Rashimud and I will put up the 20-day FLD. Let me do that right now. Here's the 20-day. In fact, let me just sort of finish this train of thought. Let me hide that 20 weeks. So there's the 80-day. So we can get in at a better level with the 80-day. So let's just take this down further and further. Here's the 40-day cycle FLD. When price crosses above the 40-day cycle FLD, what does it tell us? It tells us that a 40-day cycle trough has formed. Okay, so when price crosses above the 40-day cycle, we're bouncing out of a 40-day cycle trough. Now, is that the confidence that you need? Well, that is exactly what you need to ask yourself. At what point would you be confident? If price crossed the 40-day FLD, is that enough evidence to tell me that the 20-week cycle trough has formed? For instance, I mentioned that we should have started thinking about looking for opportunities to enter this long trade for the bounce out of the 20-week cycle at the start of that line. That line gives me the earliest possible time that the 20-week cycle trough could have formed. You will notice here that price came up to the 40-day FLD and touched it. Very important point, and I'm going to speak more about it. I see a question there. I'll get to it in a moment, Rodolfo. So price comes up to that 40-day cycle FLD. Now, if I'd started planning to enter my long trade for the bounce out of the 20-week cycle trough, Should I have entered that long trade at the level of the 40-day FLD? In my opinion, no. Last week, no. Because the 40-day cycle trough had not yet formed in the market. And if price had crossed up above this FLD, now I've made a real mess of that drawing, and let's just zoom in a little bit. If price had crossed up above that FLD, then it would have told us that price is bouncing out of a 40-day cycle trough. So if it had succeeded in getting over that FLD, then all it would have told us was that the 40-day cycle was expected in the market. When was the 40-day cycle expected? Can you see that circle there? Now, as a matter of interest, when I see a circle at the foot of the chart and a trough forming straight above it, literally on the same day, I sit up and take notice. It doesn't mean that that is definitely the 40-day cycle trough, but I think the chances are fairly good that the 40-day cycle trough did form there. Okay, of course, price might come down and form the 40-day cycle trough over here. My point is, in terms of entering this trade, it is much too early for us to be taking seriously price crossing the 40-day FLD. I hope that makes sense. Because if price crosses the 40-day FLD, all it tells us is that a 40-day cycle trough is expected, or has formed. But yes, we've been expecting a 40-day cycle, so that's not good news. It doesn't mean that our 20-day cycle trough has formed in the market. However, as time passes, and assuming that price stays down below this 40-day FLD, as time passes and we get closer and closer to the time at which we are expecting this 20-week cycle trough to form, then if price crosses up above the 40-day cycle FLD, that is significant, and that means, yes, it is probably the longer cycle trough that is formed in the market. So you can see here how we use Hurst cycle tools. Hurst cycle tools give us information about the analysis. When price crosses the FLD, it tells us that a particular cycle trough or peak has formed in the market. We can also use the Hurst cycle tools, the FLD and the VTL, to define entry levels for our trades. And that really is what we're speaking about today. How do you enter your trade? So using Hurst cycle principles, what you do is you ask yourself at what price level, either the level of a VTL or an FLD, will I have confidence that the cycle move that I'm expecting to happen is happening? And that gives you an entry level. So if I highlight the level of this FLD, you can see in Sentient Trader, I can choose here to buy at the level of the 40-day FLD. So if price bounces up and crosses the 40-day FLD, then that would be my entry. And of course, that entry level would be adjusted every single day. I'm not going to do that because I still think that if price crosses up above the 40-day FLD, it might be a little bit premature. All it's telling us is that a 40-day cycle trough is formed. But now, let me quickly see if I can get to answer some of these questions. Rajmudin asked about the 20-day FLD, right? So let me focus on that. So that's the 40-day FLD. I hope you realize how you can continue this same thought process. You can continue this same process with shorter and shorter cycles. So we can also look at the 20-day FLD. Now, when price crosses up above the 20-day FLD, would I consider that good enough evidence that the 20-week cycle has formed? No. When price crosses the 20-day FLD, it tells me that a 20-day cycle trough has formed. So let's have a look at our analysis at the foot of the chart. I'm expecting a 40-day cycle, and I think there's a good chance that that 40-day cycle formed last week. But it might still form this week. Then price is going to bounce up as it did. It's going to then come down into a 20-day cycle trough. There's the nest of lows for the 20-day cycle trough, which is expected sometime towards the end of this week, maybe early next week. That's when the 20-day cycle trough is expected. Then price is going to come back up to this 20-day FLD, And when it crosses that 20-day FLD, it tells us what? It tells us that the 20-day cycle has formed a trough. Well, that's not the news that we're waiting for. We're waiting for the news that the 20-week cycle trough has formed. Now, I'm going to sort of quickly jump ahead 40 years and speak about some of the new approach that I take to looking at these FLDs. The FLD is a very powerful tool, and as I've indicated, you can choose an entry level at the level of the FLD. But the way that Hurst spoke about price crossing the FLD was that price crosses it one way, then crosses it another way, and back and forth again and again. And let me use a different FLD here. I'm going to show you the 40-day FLD because I have a very particular point to make here. Let me just see. I think there's another question that I can answer there quickly. Rodolfo has noticed that I have a continuous FLD line in your software not. It begins after the trough occurred. Yes. So, and is it Rajmudin? I can't see the first letter of your name there. We're in the vicinity of the 40-day cycle trough. Exactly. We are now in the vicinity of a 40-day cycle trough. Right now, I believe. We're in the vicinity of a 40-day cycle trough, but we need to stand by and prepare for that bounce out of a 20-week cycle trough. Are we expecting the 20-week cycle trough to occur early or late as a matter of interest? I'm expecting it to occur early. Why? Because of the strong bullish underlying trend. I definitely have a strong bullish underlying trend. All these cycles are pushing up. The 54-month, the 80-month, the 40-week, they're all pushing up. They're giving me a strong bullish underlying trend. And so I would expect the 20-week cycle trough to occur early. So I need to be prepared. I'm standing by ahead of time. In answer to your question, Rodolfo, go to Tools, Options. On the Chart tab, there is a setting for how many cycles back your FLD will plot. It is set at 2 by default because that saves on CPU usage. Change it to about 7 and you will see the long cycle FLDs that I'm seeing here. So you just change that setting on your chart tab of your options for Sentient Trader. Now, Hurst spoke about price crossing the FLD, and when price crosses the FLD, it confirms that a particular trough or peak has formed in the market. My sort of personal research into the FLD, because I'm marginally obsessed by the FLD, and my personal research revealed a very different story. And I'm sure have heard all about this. I won't go into too much detail, but it is what the FLD trading strategy is based upon. But there is a definite rhythm that price follows with regards to the FLD. And that rhythm is this. Following, so we're looking at the 40-day cycle trough here. So following 40-day cycle FLD, I beg your pardon, we're looking at the 40-day cycle FLD. So following a trough of 2 cycles longer than the cycle that the FLD is based upon. So 2 cycles longer is the 20-week cycle. So following a trough of at least 20-week magnitude, you should get a good, clean, perfect, what's called an A category cross. Okay, that's a perfect price crossing out of price crossing the FLD. Okay, I can't seem to draw the sort of crossbars of these letters. Okay, so that's the first interaction that you get. Then, at about the formation of the 40-day cycle trough, you expect price to come back down towards the FLD and find support at about the level of the FLD. That's over there. That's called a B category interaction. So you do not expect price to cross below the FLD. You expect price to find support at the level of the FLD. Very important point. Please remember it, because I'm going to come back to it in a moment when we look at another FLD. Then you expect price to break up away from the FLD. That's a C category interaction. Then you expect price to come down to the FLD and cross below it in a D category interaction. I'm really not having much luck drawing these letters today. Anyway, so that's a D category interaction, and you expect price to cross down below the FLD. Sometimes, however, price again finds support at the level of the FLD. What does that mean? That means that you have a lot of bullishness and that your dominant cycle is probably a longer cycle. I won't go into the details because it'll take me a long time to explain, but that's a very good indication that we are looking at a dominant cycle that is at least 20 weeks in length, if not 40 weeks in length. Okay. And I see a question from Sergio. I'll get to that in a moment, Sergio. And then you get the E category interaction, which is when price crosses back up above the FLD. This pen really just doesn't really want to write for me today. And so that's the E category interaction. That's not really an E, as price bounces back up again. Then you get an F category interaction as price comes down and crosses below the FLD. And that happened over there. Perhaps I should just settle on drawing arrows. Arrows seem to work. So that's an F category interaction. Okay, as price comes down. Then you expect price to come back up to the FLD and find resistance. That is a G category interaction. And then it drops away in an H category interaction, and it comes down into the final trough of the 20-week cycle. So let's just zoom in here again and ask ourselves, when price came up to the 40-day FLD last week, what were you expecting? Were you expecting price to cross up above the FLD? Or were you expecting price to find resistance at the level of the FLD and then move downwards? I was expecting it to find resistance at the level of the FLD. And I've noticed a little trick. It doesn't always work, but watch what happens if a bar closes, if a day closes right up at the high of the trading, and it's very near the FLD. Then that's often an indication that the FLD is going to provide resistance. Conversely, if it closes near the low of the bar, and it's very near the FLD, then often the FLD is going to provide support. And that is why you need to be very careful about setting your entry levels at the level of an FLD, because often, price didn't do it here, but sometimes price will come just above the FLD, and then it will close literally sort of at the level of the FLD. Then the next morning price opens again, and it trades downwards. That's an example of the FLD providing resistance. You have to be very careful of that. Be very careful of setting your entry levels right at the level of the FLD. If there's the possibility that FLD is going to provide resistance as opposed to proving to be a perfect cross. Okay, so let's speak a little bit more about entries. I've mentioned that you could use the FLD level, which of course will update every day, because every day the FLD is at a different level. So you can use the FLD level as an entry level. Let's not use the 40-day FLD, because I've just spent quite a lot of time explaining why I wouldn't use the 40-day FLD. Let's really take this seriously and speak about trying to find an entry into our trade out of this 20-week cycle trough. I would definitely consider entering at the level of the 80-day FLD. Where is that FLD today? It's right up here. Okay, so you could set your entry at that level. I wouldn't. I think that's a little bit premature, but we are expecting an early bounce out of this 20-week cycle trough, and so fairly soon you need to start watching this 80-day FLD and setting the level of that FLD as an entry level. Now, Hurst suggested two different approaches. The one is what he called an active action signal. An action signal is something that consists of two parts. It consists of a signal and an action. The signal is price crossing the FLD, and the action is a trading action, such as entering into a trade. An immediate action signal, or sometimes it was called an active action signal, was a signal where the action was immediate. So as price touches this FLD, let's assume price comes down here, fiddles around down here, and then comes up and crosses the FLD over here. If we have an immediate action signal, then as price touches that level, we will enter into our trade. That is our entry level. The other alternative is to have a delayed action signal, and a delayed action signal will avoid situations like this over here, because you can see here price came up just above the level of the FLD and then it dropped down. A delayed action signal says that you wait for the bar to complete, you wait for the day's trading to finish, then you set your entry for the next day of trading just a little bit above that level, or if it's a short trade, it would be below that level, and that would be your entry. That's a delayed action signal. When should you use immediate action signals and when should you use delayed action signals? My opinion is you apply some of the reasoning of the FLD trading strategy and you start looking at what price is doing with the FLD. For instance, if we were considering entering into a long trade last week and we had maybe started watching this 80-day cycle FLD, I would certainly not have put an immediate action signal at the level of the FLD. Why? Well, because price came down and touched the FLD over here. Then it came down and it tracked along the FLD for 3 bars over there. What is price doing? It's trying to get through that FLD. It's trying to cross it, but the FLD is providing support there. It hasn't got through it. So the FLD over the weekend jumped up, but so did price just a day or two later. All that price was doing was it was tracking along that FLD. I hope you can see that. Sometimes I think perhaps there's something sort of slightly wrong with me and I just keep seeing patterns between price and the FLD. But it is extraordinary how often price responds to the FLD. Here you can see an example of price finding support at the level of the FLD over there. Here price came down to the FLD and give or take a day or two where it didn't actually sit on the FLD, it pretty much sat on that FLD, straddled that FLD all the way up there. So I certainly would not have set an immediate action signal at that point. It would be very premature. When a trough becomes overdue and you're really expecting it, that's when you could set your immediate action signal, because you are expecting an A category interaction in terms of the FLD trading strategy, and when price crosses that FLD, it is likely to be a good, clean, strong cross. I see Rodolfo, 2 questions. First of all, Sergio, do you expect the second peak of the 40-week cycle lower than the first? Okay, that's an interesting question. So let's take a moment to consider that. And I wonder if you meant the 40-week as or the 40-day. But let's the answer to that question. I seem to have got lost in my zooming. Here we go. The answer to the question of do we expect a higher or a lower peak in as for the second peak? Okay, let me just show you what I hope Sergio is asking, my understanding of the question. We have an M shape which is forming here, move down into the 20-week cycle, up to another peak, and then move down into the 40-week cycle trough. I think what Sergio is asking is, do I expect this peak to be higher, than this peak? Okay, the simple answer is that what you always do is you look at underlying trend, Sergio. That's the simple answer. If your underlying trend is bullish, then you expect the second peak to be higher. If your underlying trend is bearish, you expect the second peak to be lower. So, and what underlying trend, or the underlying trend of what cycle? Well, in this case, I've drawn the M shape of a 40-week cycle. I wonder if I can write 40-week. I'll try. That's a 40-week cycle I'm looking at. So when considering the peaks of the 40-week cycle, I must look at the underlying trend of the 40-week cycle. So that's the cycles longer than the 40-week cycle. In this case, the 18-month cycle is up. The 54-month cycle is up, I do believe. If you're working with a different analysis picture where the 54-month cycle is has not formed a trough, then it would be coming down. So your answer to that question depends on your analysis of where the longer cycle troughs are formed. So the analysis we're looking at on this chart with the 54-month cycle trough that formed in February has two cycles that are moving up. Then the longer cycles we could debate, but the 9-year cycle is probably moving down, so that's a -1. The 18-year cycle, I believe, is in the process of topping. I'm going to give that a 0. And sigma L, I believe, is actually in the process of sort of turning down, so I'm going to give that a 0 as well. So altogether, my underlying trend is +1. It's a slightly positive underlying trend. In other words, the answer to your question is yes. With a positive underlying trend, I do expect a higher peak. If, however, you think that the 54-month cycle trough did not occur there, then you would end up with a bearish underlying trend, and you would expect the second peak to be lower. Okay? So, but nevertheless, you're expecting a peak at about the same time as that other person. It's just a question of is it a higher peak or is it not quite a higher peak? I am expecting a higher peak, I'll be honest, but if the market starts turning bearish really quickly, then I'll change my analysis. One has to keep on one's toes as an analyst and, not stick with your decisions that you made several months ago. Okay, so let's just quickly wrap up the discussion of the FLD. I would like to, in terms of making an entry, the safest entry to make is at the level of the 20-week FLD, because when price crosses above the 20-week FLD, that tells us that the 20-week cycle trough is formed in the market. That's where I started this discussion. And as I mentioned, if you're an optimist and you think half the move is still ahead of you, then it'll give you a good entry. But now here something interesting is happening, because the 20-week FLD is still below price. So we probably expect price to drop down below the FLD to come and form the trough of the 20-week cycle, at which point we could use the 20-week FLD as our entry into that trade. Okay. Now, there's an interesting thing here. I've just explained to you the sequence of interactions that happen between price and the FLD. And that sequence does apply to all end-of-day cycles, or longer than intraday. Intraday, this sequence gets very complex, and it's not a reliable sequence at all, I believe. There might be people who disagree with me, but the sequence of interactions intraday is not very reliable. But now, let's have a look at what sort of sequence of interactions we're expecting here according to the FLD trading strategy. This trough in February was a trough of at least 18 months, as I've mentioned many times. Okay, the first interaction with the 20-week cycle FLD is expected to be a good clean cross, what I call a golden cross. And that was our golden cross, perfect trading opportunity, and we see price coming up, and it should achieve and fulfill its target. Interestingly, it hasn't. That's slightly worrying. That means we've got a bit of a turn to the bear that's happening here, because it didn't quite achieve its target, and I haven't worked out that target very accurately, but I know that it didn't quite achieve that target. So what interaction do we expect next? We expect price to come back to the 20-week FLD, and that will be a B category interaction. And what happens at a B category interaction? We expect price to find support at the level of the 20-week FLD. So let's just zoom in again and ask ourselves, would we use the 20-week FLD to enter into our trade for the bounce out of the 20-week cycle trough? We can't really, because price is still above the 20-week FLD. Are we expecting price to plunge down and come way below it? Well, it might do, and we should stand by and be ready for that. But we should also watch this FLD very carefully, because we are expecting the 20-week FLD to provide support for price at about this time. Now, you must be very wary of this. A 20-week FLD, that's a lot of weeks, that's 5 months, and so you get a lot of sort of detailed wiggling about over here. And so providing support needs to be taken with a grain of salt. You know, price can drop a little bit down below it and then sort of pull back to it. And then when we look back and sort of change the scaling of our chart and view the chart as a weekly chart instead of a daily chart, which we can do here, you know, then we might say, yes, price did provide support. Price did find support at the level of the FLD. So that is definitely something to be aware of, to be wary of, that the 20-week cycle FLD might very well provide support. Okay, so let's quickly get back to our discussion of finding entries. We can use our FLD tools to find entries. In particular, we can use the FLD, as I've discussed at some length already. There is another tool, the VTL, which is a tool I don't speak about very often because it can be a little bit misleading, I believe, and I'll see if I can explain why that might be. Okay, as price is coming down into this 20-week cycle trough, which cycle VTL would provide us with evidence that the 20-week cycle trough is formed? Well, it's not the 20-week cycle VTL. In the case of the VTL, it's one cycle shorter. So we will have evidence that the 20-week cycle trough has formed when the 80-day cycle VTL has been crossed. Now, why don't we have a downward pointing 80-day cycle VTL here? It's because a VTL has to follow certain rules, and the primary rule of the VTL is that it must join the peaks of 2 consecutive cycles. So here's the cycle of the first 80-day cycle. Here's the peak of the first 80-day cycle. And here, so far, is the peak of the second 80-day cycle. If I join those two lines, I end up with a trend line that moves upwards. So that's not a downward pointing trend line. It's not a valid trend line. So therefore, it's not plotted on the chart as a VTL. So we can't use the 80-day cycle VTL to determine our entry into this trade. But we can use the same principle that we used when discussing FLD entries. And that is that we work with shorter and shorter cycles. So when the 40-day cycle FLD is crossed, then that tells us that the 80-day cycle has formed a trough in the market. So let me zoom in again, and let's speak about a 40-day cycle VTL. We need to join the two peaks of 2 consecutive 40-day cycles. So here is my 80-day cycle back on the 12th of April. Price went up and it's coming down now into a 40-day cycle trough, or it might have formed the 40-day cycle trough last week. It seems fairly apparent that the peak of that 40-day cycle was that high point over there back on the 20th of April. Now we need to join that high point to the peak of the next 40-day cycle. So we can't do that yet. So this entry level isn't available to us. Okay, but it will be soon. And as we track the progress through time of the market, we're adjusting our analysis and our trading decisions every single day. And if price continues downwards at this point, then we might find that this turns out to be the peak of that 40-day cycle, and there will be our 40-day cycle VTL, which would be a line over there. We cannot plot it yet, but we might be able to plot it fairly soon. So I hope you can see how the process of trading using Hurst cycles is a process that develops over time. You first of all identify your trading opportunities, and then you decide, where would I enter into my trade? And you start watching some FLDs, and you also start watching for some VTLs. Sometimes you have to wait for those VTLs to actually form in the market. And once the VTLs are on your chart, then you can use them as entry levels. And as Najmuddin says, the 20-day VTL can be used to locate the 40-day cycle trough. Yes, exactly. And let me just show you something. Here is the 20-day VTL. And this illustrates an important point that I want to make about VTLs. Here is the 20-day VTL. It has found this peak over here and this peak over here. It has drawn that line. It has discovered it gets broken by price, so it adjusts the VTL, which is what Hurst said you must do. You must adjust your VTL if the VTL gets broken. So it's adjusted the VTL, and that is a genuine Hurst valid trend line. However, and it has been crossed, I should say. It's been crossed. It was crossed last weekend, telling us that this is the 40-day cycle trough. However, there's a really big caveat that you need to bear in mind when working with VTLs. The VTL is very closely based upon your analysis. And so a VTL becomes a sort of a self-reinforcing loop, if you like. You must be careful with VTLs because they often give you the information that you want to see, because it's on the basis of the analysis that you have that you have yourself performed. So you have to be a little bit careful with VTLs. It's just a word of caution. But yes, indeed, the 20-day VTL can locate the 40-day cycle trough. So as time passes and as we move into the future, and perhaps price moves down a little bit to come down into this 20-week cycle trough, we would then, perhaps this is the 40-day cycle trough, then we would get a 20-day VTL, which will look something like that, and then we can use the 20-day VTL as well as an entry level. Okay. One final sort of thing to speak about, which is the current trading opportunity, because in our previous webinar we identified two trading opportunities. The one was the long trading opportunity as price breaks or bounces out of the 20-week cycle trough that's expected towards the end of May. And that is still, in my opinion, a good trading opportunity, and it lies ahead of us. We have time to plan for it. I hope you're beginning to see how making these sort of trading decisions on an intraday basis can get a little complicated, because you have to start planning ahead. You find your entry levels, you find your VTLs, your FLDs, and those are your entry levels for getting into those trades. So that is still a good trading opportunity. But the other trading opportunity that we identified in our previous webinar was the short trading opportunity, as price bounced out of the, I shouldn't say bounced, let me say that more carefully, turn this pen on. I expected price to come down, form a 40-day cycle trough, which it possibly did last week. Then it was going to bounce up, and the short trading opportunity was the opportunity of going short as price came down into the 20-week cycle trough. Is this still a good trading opportunity? Yes, it is, if you are interested in a fairly quick trading opportunity. There are several things that count in its favor. Take a look at the hurstcycles.com website. Jeffrey wrote a great post over the weekend about the head and shoulders pattern that is forming. And let me just change the scaling. There's a head and shoulders pattern that is forming. The neckline hasn't been broken yet, but I think you can see there's the left shoulder, there's the head, there's the right shoulder. If the neckline is broken, which is that line over there, if that line is broken, we would expect to move down, and you would expect it to come down like that into the 20-week cycle trough. So if this level here is broken, that represents probably a good trading opportunity. The trading opportunity is still there. Personally, I think that this trading opportunity might be slightly behind us. We might have missed it. We could certainly use a price level such as that neckline to enter into this trade. But let me just remind you that around about now, we are looking at the possibility of a mid-channel pause forming. in the 18-month cycle. Now, the 18-month cycle is a nice big cycle. It's an important cycle. It's one we really need to bear in mind. So let me just come right back to that and sort of bring that full circle, that comment that I made earlier about the 18-month cycle. And let me pull that down. So I said this earlier, I'll repeat it here. The 18-month cycle is expected to form an M shape, which should go up, come down, form a mid-channel pause at around about the level of the 20-week FLD, and we're approaching that point around about now. Then it's going to come up, form a higher peak in answer to, I think it was Sergio's question, form a higher peak, come down into the 40-week cycle trough. There's the circle for the 40-week cycle trough. Then it'll come up, form another peak, and then come down again into the 18-month cycle trough. We must bear in mind the possibility that we are now witnessing the formation of a mid-channel pause in the 18-month cycle. Very important. Please bear it in mind, because if this is the mid-channel pause for the 18-month cycle, then we will see price come down to the 20-week FLD and find support at the level of the 20-week FLD, and then it'll bounce back out again. So there are several reasons why the current short trade might not be a very good idea. But it is still a trading opportunity, and it is one that you might want to consider. Personally, I think we might be slightly too late. Let me finish off this webinar by speaking about a fairly advanced way of entering into trades, and that is also using the FLD trading strategy. And it comes back to the sequence of trades, and this is the kind of thing I spend my days doing. You can see how much fun I have. I look at the interactions between price and the FLD, and I've already drawn the sequence for you, but there's the A category interaction over there. Here is B, C, here is D, here is E. Then we had F as price crossed down below the FLD. What did we expect next? We expected a G category interaction. That pen is really not playing ball, but let's zoom in and speak again about what we expect at about the time that a G category interaction forms. We expect price to come up to the FLD and find resistance at the level of that FLD. Last week, somebody sent us a tweet. I think that's what you call them on Twitter. Somebody sent us a tweet saying the 80-day cycle trough has formed and is behind us. Personally, I wasn't feeling very bullish, because price was coming up to that 40-day FLD, and it touched that 40-day FLD. On some analyses, that 40-day FLD was 1 or 2 days either side. So it was touching that FLD, and I was fully expecting that FLD to provide support. To provide resistance, I beg your pardon. So here's an advanced trading strategy for you if you're interested in jumping right ahead and just doing this in a very advanced way. When you're expecting price to come back up to the FLD, and here's my word of advice in terms of doing this, because there are a few things to look out for. First of all, look out for your golden cross. A golden cross is this thing over here, where price crosses down below the FLD, and it comes right down, and it should ideally fulfill its target. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. So it comes down and it hits its target over here. Following a golden cross like that, look for price coming back to the FLD. If you're brave and have nerves of steel, set yourself a limit entry at the level of the FLD. What's your downside? Your downside is if price clearly breaks up above the FLD and exceeds the previous high, then that's your stop. So here was our short entry. It's called fading the move. So you set your short entry at the level of the FLD. It's a limit entry. In other words, we're expecting price to just get to that level, and then you sell into the upwards move, and then you expect price to reverse. It's a fairly advanced trading strategy. It could have been a way that you could have benefited from this move down, which is of course not yet complete. We're still expecting this move to come down because the 20-week cycle trough is only expected towards the end of May. You can see those circles and whiskers coming in there at the end of May. So that's a fairly advanced trading strategy. Just to finally wrap everything up, and let me just continue that idea of an advanced trading strategy. I've just explained why price might be expected to find support at the level of the 20-week FLD. So another thing that you could do is, as price hits the 20-week FLD, is do the same thing but create a long entry at that level. I would not recommend doing that on a daily chart with a 20-week FLD, because there's too much noise in the 20-week FLD, and price could come a little bit below the FLD. So I wouldn't recommend doing that on a 20-week FLD, but it's certainly something to bear in mind. As price approaches that 20-week FLD, I am definitely going to stand by for entering into that long trade. But personally, this is my own personal trading style. I don't particularly like to jump into trades prematurely. I like to see the formation of a trough or a peak, but particularly a trough. I like to see the formation of that trough. I like to have it confirmed before I jump into a trade. And that really sort of brings me to the end of moving from trading opportunities to identifying trading levels using Hurst's trading methodology. As I mentioned at the beginning, there are as many different trading entry strategies as there are Hurst cycles traders. But the important thing, and the message I hope to convey in the course of today's webinar, was that you can apply Hurst's principles, the principles of underlying trend, and you can use Hurst's tools to define and find your entries. So you enter your trades on the basis of what price is doing when it reaches one of Hurst cycles tools, and you can structure your expectations for the trades on the basis of things like underlying trend and what the possibilities are in terms of the analysis. Let me see, some questions. Nathan, I set up 18 months from February the 11th, but all cycle lengths showing me longer, like 55 weeks, 29 weeks, 120. Okay, so they're all, where did I make a mistake and where can you correct, like your chart? Okay, it's very difficult for me to say, just off the top of my head, what's happening with the analysis. Let me show you this analysis and speak about the ways in which Sentient Trader calculates those wavelengths. So what Sentient Trader does to calculate the wavelength is it looks at the most recent 6 iterations or waves of a particular cycle. So if your 40-week cycle is showing you a length of 55 weeks, then you need to look at your previous 6 40-week cycles. So let's quickly do that here. 1, 2, 3, 4, 5, 6. So your previous 6 cycles will take you all the way back to sometime in 2012, probably. So here are the 40-week cycles that I have on this particular chart, and you can see I haven't pinned any of them. So I haven't influenced the analysis in any way, but presumably one of the one of these cycles here on your analysis is looking different, Nathan. If you and you can see why that might happen. Here you've got a trough, here you've got a trough, here you've got a trough. You've got lots of small, rather insignificant troughs, which could all qualify as troughs of 18-month and 40-week cycle troughs. Okay, it's been very difficult to perform an analysis, but what you will find is that your analysis differs from mine. You might find that the 18-month cycle trough has been positioned over here, and then this is a 40-week cycle trough, and then somewhere over here is another 40-week cycle trough. So Sentient Trader has stretched the cycles. So have a look at your analysis, because the recent wavelength is calculated by looking back 6 cycles. Or 180 bars, actually, because that's what Hurst did, is he looked back 180 days. So for 20-day cycles, it looks back a bit more than 6 cycles. And as John says, try using the initial cyclic model setting and set the data to 1990. You might get shorter cycle periods. Exactly. So you know that Sentient Trader can perform an analysis where it refers to your nominal model and it finds cycles as close as possible to that nominal model. The initial cyclic model setting, and there's a button up here in the toolbar, I can show it to you. The initial cyclic model, there's the button, it says NM, and it tells me that the nominal model is being used as the basis for phasing analysis. If you click that button, it will change to ICM, and it asks you, it sort of gives you a threatening message, so we're going to say no to that. But you can then re-perform the analysis, and it performs the spectral analysis again. Sentient Trader performs spectral analysis at the beginning of its analysis process. So it performs the spectral analysis again, and then what it does is it refers to your nominal model, but it places a heavier emphasis on the spectral analysis. And that produces what Hurst called an initial cyclic model. And you will end up with slightly different wavelengths. And as John says, you'll probably find, if you use an ICM, initial cyclic model setting, you'll probably find that Sentient Trader will find those shorter cycles. I know John does a lot of work with initial cyclic model setting, and finds a lot of shorter cycles. In fact, here's a chart showing that with a 7-year cycle instead of a 9-year cycle, and all that kind of thing. So you can get various variations on your cycles. Najmuddin says the cycles in the analysis we discussed today are significantly shorter than the ICM. Well, I should say that the ICM is the initial cyclic model, so it includes all the cycles, and depending on what data you're analyzing, you'll get different values for the ICM. So I'm not sure which ICM you're looking at, Najmuddin, but I try to normally speak about what we call the nominal cycle length. So in other words, when I speak about the 40-day cycle, the average length of that is actually 34 days, and currently it might even run shorter to about 26 days or 24 days for the 40-day cycle. And you're saying the 80-day cycle is showing about 40 days. Okay, yes. So the recent cycles, that's right. I think down here the 80-day cycle recently has been running at 49 days. That's right. So according to the analysis Sentient Trader has here, the cycles have been running a lot shorter than their expected average wavelength, because of course this approach to the markets is a fairly dynamic approach. We work with cycles that have fixed names. The 80-day cycle is a name we always refer to, but it doesn't always take 80 days for that 80-day cycle to play itself out in the market. The average length of an 80-day cycle is 68 days. And you can see that currently, I don't know if you can see it, it's at the bottom right-hand corner of the chart. Currently, that 80-day cycle is shown to have been running at about 49 days. So indeed, it's been running very short recently, according to this analysis. Okay, it'll always depend on what on what analysis you're working with. And John says the straddle low in January, February causes some angst. Yes, that's right. Straddle troughs always do cause some angst, not only in traders but also in Sentient Trader. And a straddle trough, of course, is a trough that is not as sort of prominent as we would expect. So we had a big move up, and then we had a little move down. And so this trough here effectively is a fairly straddled trough, so it causes quite a lot of angst or analysis anxiety, I suppose. If there are any more questions, I'll be very happy to answer them, but I think it is time for me to wrap up today's webinar. Thank you very much for joining me. I look forward to seeing you at our next webinar, which will be in 2 weeks' time. Thank you for your interest in Hurst Cycles. Thank you for being a part of our community, and I look forward to seeing you in our next webinar. And I wish you, in the meantime, profitable trading. And I hope that you have learned a few tips today in terms of identifying good trading entry levels. So I hope that's proved to be helpful for you.